Hello and welcome to this special CNBC broadcast of the MPC. Lesetja Kganyago is ready and is in Pretoria right now to announce the next repo rate. Let's listen in.
The longer-term economic outlook, however, remains clouded by risks to the inflation trajectory, ongoing geopolitical tensions, and the effects of climate change. China's growth performance is expected to remain modest, with little benefit to commodity prices. In the developing world, many economies face high debt levels, weaker economic growth, and prolonged adverse financing conditions. As a result, sub-Saharan Africa's growth prospects remain muted. While goods price inflation has eased in much of the world, core inflation remains elevated, keeping consumer price inflation from falling more sharply. Globally, monetary policy is likely to remain focused on ensuring inflation continues to retreat, implying policy rates will stay higher. We expect markets in major financial centers to remain volatile. Taking these and other factors into account, the SARB's forecast for global growth in 2023 is revised marginally higher to 2.5% and remains unchanged at 2.7% in 2024. While South Africa's economic conditions appear to have improved, the longer-term outlook mirrors the uncertainty of the global environment. Prices for commodity exports continue to weaken. In addition, energy supply pressures remain, and stronger El Niño conditions threaten the agricultural outlook. For 2023, the bank's forecast for South Africa's GDP growth is slightly higher than in May at 0.4%. Energy and logistic constraints remain binding on the growth outlook, limiting economic activity and increasing costs. From a demand perspective, spending by firms, households, public corporations, and general government remains positive in real terms. Disposable income of households continues to grow, albeit slowly. Investment by the private sector and the public sector is revised up, and the terms of trade have remained more beneficial than previously forecast. Debt service costs of households have increased to 8.4% of disposable income and now sit at around the average for the past decade. Although credit growth to households and corporates has slowed in recent months, it has increased in real terms compared to last year. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1% and 1.1% respectively. While households and firms exhibit resilience, economic growth has been volatile for some time and highly sensitive to new shocks. An improvement in logistics and a sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. Turning to inflation prospects, our current growth forecast leaves the output gap around zero over the next 3 years, implying little positive or negative pressure on inflation from GDP growth. South Africa's external financing needs are expected to rise due to expansion in the current account deficit. Despite somewhat lower oil prices, falling export commodity prices are forecast to result in a current account deficit of 1.9% of GDP this year, 2.9% and 3.3% of GDP in 2024 and 2025, respectively. Sharply lower tax revenue, higher employee compensation, and ongoing financing needs of state-owned enterprises are likely to keep the long-term cost of borrowing elevated. Despite the expected moderation of inflation over the forecast period, long-term bond yields currently trade at about 11.6%. The rand has generally weakened over the past year, depreciating by about 5% year to date against the US dollar, and showing high volatility in response to risk-on and risk-off episodes. The implied starting point for the rand forecast is 18 rands 52 cents to the US dollar, compared with 18 rand 73 at the time of the previous meeting. The trajectory for South Africa's headline inflation has been shaped primarily by fuel, electricity, and food price inflation. Compared to the previous meeting, fuel price inflation is lower at negative 3.1% in 2023. The electricity price forecast is unchanged at 11.6% this year, 13.6% in 2024, and 10.9% in 2025, I'm sorry. Our food price inflation forecast for 2023 remains high, but is revised lower in this meeting to 10.3% and up slightly to 5.2% in 2024. Better monthly outcomes have led to a downward revision in our forecast for core inflation to 5.2% in 2023, 4.9% and 4.5% in 2024 and 2025, respectively. Services price inflation in 2023 is expected to come in at 4.8%. Core goods inflation, while still elevated, is also revised slightly lower for this year at 6.2%. Growth is in average salaries and unit labor costs is lower in 2023 and 2024 and slightly higher in 2025. Core goods and food inflation, with core goods and food inflation lower in the near term, headline inflation for 2023 is revised down to 6%. The headline inflation forecast for 2024 also decreases to 5% before stabilizing at 4.5% in 2025. Risks to the inflation outlook are assessed to the upside. Headline inflation at a global level continues to moderate, but food price inflation remains high and oil markets remain tight. Despite recent easing in some food price components, domestic food price inflation is still elevated at 11% in June, and the risk of drier weather conditions in coming months has increased. In the absence of sustained and consistent increases in energy supply, electricity prices continue to present clear inflation risks. Load shedding and logistics constraints may also have broader effects in the cost of doing business and the cost of living. Given uncertain fuel and food price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation in major economies suggests that average interest rates in these economies will remain high. As a result, tighter global financial conditions are likely to persist, raising the risk profile of economies needing foreign capital. Higher inflation outcomes have generally resulted in elevated inflation expectations across businesses and households, while market-based expectations have eased recently. The Bureau for Economic Research survey released in July shows average inflation expectations of 6.5% for 2023. Inflation expectations for inflation in 2023, based on market surveys, are currently 5.9%, and near-term break-even rates have decreased to around 4.5%. Longer-term expectations remain elevated. Headline inflation returned to the upper end of the inflation target range in June and is forecast to sustainably revert to the midpoint of the target range by the third quarter of 2025. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. Against this backdrop, the Monetary Policy Committee decided to keep the repurchase rate at the current level of 8.25%. 3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with still high inflation expectations and the outlook. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant, and decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. Guiding inflation back towards the midpoint of the target band reduces the economic cost of high inflation and will achieve lower interest rates in the future. Since early 2020, the committee has recommended additional and indirect means of lowering inflation that are within the reach of the public sector, including achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps would strengthen monetary policy effectiveness and its transmission to the broader economy. The repo rate projection from the updated quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes the MPC statement, and as usual, we would open questions and identify yourself and the name of the media house that you represent. this will be a first. No questions.
Afternoon, Governor and Deputy Governors. I'm Tana Anders from Reuters. I have two questions to start off with.
Did you say Tanya?
Tana.
Tana?
Yes.
Okay.
The MPC has revised its GDP growth projections at each of its meetings and now settling on 0.4%. Which of the underlying assumptions have changed that has resulted in this upside revision? And then similarly, what is the MPC's medium-run projection for both these assumptions and growth? And then my second question, restrictive monetary policy's function is to tighten inflation, but can also slow growth. How much longer can you justify restrictive policy? And do you have an estimate on how many percentage points it will shave off growth this year? Thanks.
Another one? Okay, online?
Governor, I have just one question from Audrey at Business Report. Is it not time to reduce the spread between the repo and the banking lending rate?
My name is Tembi Leqele from Bloomberg News. Thank you, Governor. First question, have interest rates peak, and when do you think South African borrowers could expect lower interest rates? And then after yesterday's surprising slowdown in inflation, do you expect that trend to continue, or do you expect that inflation will remain sticky, and if so, why? Thank you very much.
Okay, thank you very much. GDP revisions, what assumptions have changed? I think that the big changer had been that load shedding had been less intensive than we had actually seen. That's the first thing. But the other was that the starting point for our growth forecast was higher because of the better outcomes that we actually had seen. So that's what been the key drivers. In terms of the medium term, what assumptions? We make assumptions from one meeting to the next in response to changing data and risks. And the things that we make assumptions about are things we are really uncertain about, whether it is load shedding, whether it is oil prices, or whether it's what the other central banks would do around the world. Those things are constantly changing, and you cannot make medium-term assumptions. You have got to take them from meeting to meeting. Restrictive policy is known to cap inflation. That is exactly why we have a restrictive policy. We are an inflation-targeting central bank, and this is the tool that we have, and it's a tool that we would deploy in response to any inflation risks that on the horizon, and in response to the outlook that we foresee. It is known that it could cap growth. Yes, it does have an impact on growth, but it only has an impact on cyclical growth. What sometimes worries me is the discourse on growth that seems to think that you can change the long-term potential of this economy by playing around with monetary policy. Monetary policy only affects cyclical growth, meaning it affects growth over the next 3 to 6, 8 quarters at most, and beyond that, it doesn't do much. But has monetary policy really restricted growth here? Well, what is the potential growth rate of this economy? The potential growth rate of this economy is minuscule, negative 0.1 or so, and that even at this low rate of growth, the output gap is closed. The output gap is zero. And as we state, the output gap will tell us whether there are upward or downward pressures in the economy. And given that it is zero, we do not see upward or downward pressures in this economy. And we believe that given the risks to both growth and the inflation outlook, that our stance is an appropriate stance. Spread between banks and between the repo rate and banks, we do not set that spread. As you might know, some people borrow at prime plus something. Other people borrow at prime minus something. Others borrow at prime. So that there is that spread between prime and the repo rate, it's there. But how relevant is prime? I mean, if you are borrowing at prime, we could as well just say that the bank is pricing you at repo rate plus 350. And if you are borrowing 1% below prime, we can say that the bank is pricing you at the repo rate plus 250. So it's a never-ending conversation. That's I think as if everybody borrows at prime. There aren't that many people borrowing at prime, which is why it is called prime in the first place. You have got to be a prime customer. Tandi, have interest rate peaked? The answer is a resounding no. And as a good central banker, I will say to you, further than this, it depends on what happens to inflation. And so we have presented an inflation forecast. With this forecast, we expect that we would come back to the midpoint of the inflation target range in 2025. We continue to assess data and risk from meeting to meetings, and we will recalibrate policy based on those risks. Is this the end of the hiking cycle? No, it is not. It depends on the data and risks. That is what this boils down to. What is the inflation trajectory that we are seeing? We gave you a little sheet there. We expect that inflation this year will average 6%, that it would go to 5.3% in 2023 and decline further in 2025 to 4.5%. So that is the trajectory that we are actually working with at the moment. No, 2024 is actually 5%, not 5.3, 5%. Anybody on the line?
Yes, Governor. This question is from Spelele Zludla at Business Report. What were the reasons for the 2 MPC members who preferred a 25 basis point hike? Then Atwal Dlamini had a question, but it's similar to Stembile's one, and you've just responded to it.
Okay. Any others?
Governor, thanks. Alistair Bull from Bloomberg. You've said that this isn't necessary.
To say Alistair Bull.
That's correct, yes.
Welcome back.
Nice to be here, sir. You've said you're not declaring an end to the hiking cycle, but so could you tell us what your threshold would be to either raise rates further or to cut? And give us some sense of how long you think you have to stay tight. Thank you.
Monique, also from Bloomberg. Could you give us your Q2 growth forecast, please? Estimate.
Another 3 questions this side, please. The impact of South Africa's energy crisis and its role in driving up costs has been covered quite extensively. Has the MPC considered the emerging concern of water infrastructure and the impact that will have on inflation? And then just secondly, given that the quarterly projection model has been adopted, how did it affect this meeting? And then lastly, given that there has been rigorous tightening of monetary policy, do you believe that the current monetary policy and fiscal policy mix is a sustainable combination for economic growth?
Okay. Chris, I'll give you the growth and quarterly projection model questions to deal with. Kuben, you will deal with what would it take to raise rates and what would it take to cut rates? I think I've answered this question 3 times before. Let's see whether you have the same answer. Spelele, the reasons for the other two members to raise rates, you are presuming that this one standing here couldn't have been either of the two. You can guess the way you like, you will never get it right because these things change from meeting to meeting given data and the inflation outlook. The reasons for keeping rates the same and the reasons for increasing rates are all captured in this statement. So in this statement, you will find the reasons of everybody who argued in the MPC. So it sounds like the same answer we have given before. You will get the same answer at the next meeting.
Okay, so that's the governor of the South African Reserve Bank, Lesetja Kganyago. He looks like he's in a fully combative mood and giving it as he is getting it. So the decision, in line with market expectations, no change. Annabel Bishop, Chief Economist at Investec, is in the studio with me. Annabel, I see you were in the right, and this time my guess, because that's what it is, I'm not an economist, my guess was in the wrong. Are you convinced by the reasons the governor is giving?
You know, I actually thought it was quite a hawkish statement. I wonder if he was not the person who voted for the 25 basis point hike.
He says you will never know.
You'll never know. But he does get 2 votes and everyone else gets 1 vote. No, he sounded very hawkish. I think, you know, we find ourselves in a situation in South Africa where inflation has come back quickly into target this month compared to other compared to other countries around the world, particularly key advanced economies. And of course, if we actually have a look at next month, we're likely to see it at 4.5%. So inflation reaching the midpoint. We disagree with the governor. We think next year we're probably going to see inflation of around 4.5%. Sure. But again, much depends on climate change and of course the impact on food price inflation.
Substantially so in terms of that difference. But I wanted you to help me understand what's going on with the rand here, because I am saying since the governor began speaking, the currency has weakened. And we know the answer is a hold. And we've also seen the reasons behind the governor and the MPC's decision to keep rates on hold. Someone is disappointed here. Why would they be with this outcome?
So I think if you have a look at the forward rate agreement curve in South Africa, the FRAs, they'd only partially factored in a very small amount of a hike, you know, less than 10 basis points when I looked yesterday. And of course, you know, that really meant that the financial markets were expecting no interest rate hike. The economic consensus was fairly evenly split between 25 and nothing. If we now have a look at the global financial markets, in contrast to South Africa, they have actually factored in an interest rate hike of 25 basis points for the United States. And of course that obviously, you know, is close to about 23, 24 basis points last time I looked, fully factored in, which means that the differential between South Africa and US interest rates would widen further. And of course that is negative for the rand. We also of course as well have some US data coming through in the markets. But I think overall, with the United States pausing at its last FOMC meeting, South Africa was quite likely to pause at this MPC meeting.
Absolutely, and pause they did. So when you take a look at the markets, so the rand, as I was saying, has weakened slightly. On the equities market, that market has actually gained a little bit. We're down 0.2% before we started speaking. Now we are down 0.1%. So your rand edge is perhaps maybe climbing up a little bit. But we're going to get into a lot of detail of all of that on the other side when we come back. And we also have the results of our poll that we ran. We were asking, the bank is going to be talking about its decision here today because we are seeing an environment of cooling inflationary pressures globally as well as here in South Africa. And we asked the question, should the bank add to the 475 basis points it has already imposed? The results on the other side.